None of VPM Partners, Bob Kendall, or any of its officers, directors, employees, other personnel, representatives, agents, or independent contractors is, in such capacities, a licensed financial advisor, a registered investment advisor, or a registered broker-dealer. None of VPM Partners or its personnel gives investment or financial advice or makes investment recommendations, nor are any of them in the business of effecting trades or directing client equity accounts or giving futures trading advice tailored to any particular client situation. Nothing contained in VPM Partners broadcasts, on its websites, or in its written materials constitutes a solicitation, recommendation, promotion, endorsement, or offer by others described above of any particular security, other investment product, transaction, or investment. Copyright 2014 VPM Partners. All rights reserved. Terms of use apply. Reproduction, adaptation, distribution, public display, exhibition for profit, or storage in any electronic storage media in whole or in part is prohibited under penalty of law.
Good morning, everyone. It is Monday again. These weeks seem to click by too fast. We're 2 weeks away from the end of summer, if you can believe that.
That's crazy.
It is. Anyway, a lot going on. This rally's continuing. Mitch put the headline out on our broadcast, the last leg. Maybe it's the next leg. We'll see what happens here. There's some pretty interesting things going on from the standpoint of the technicals that are evolving. Even though the indices are moving, there's a lot of the backdrop is not. So we'll have to see what goes on there. So Mitch, we had the real estate come out this morning, the index.
Yeah, the housing market index came in, and it beat expectations. Came in at 55. Consensus was for 53. So this is the home builders index on it. And just to give you a little bit of perspective, this is the highest that we've been at for about 7 months. So it certainly is a little bit higher than we've seen in some time, at least recently. This also puts us back towards the highs that we saw about a year ago. And that was the highest that we had seen going back to 2007, 2006, somewhere in that neck of the woods.
I see. Okay. But it wasn't like an 03 value pretty much? So
Yeah, I mean, if you actually look back at the data on this, and you can go to the NAHB's website and pull up the same data that we pulled up, you can see that really this is the level that we saw back in the 80s, back in the 90s, and saw lastly around 2003 before it really started ballooning up towards the 70 level, which is right where the bubble burst before it dropped all the way down to around 10 or 5 or something like that, in the worst of it in 08 and 09. So we're getting back towards, I guess, what could be considered lower to normal levels over the last 10, 12 years or so. Certainly over the last 20 years, but certainly not as high as we saw around 2000 or 2007.
But this is a builder's survey index, right? So
Correct.
It really is probably not very relevant to anything other than how those guys are feeling, right?
Well, I mean, how do you measure feelings is already sort of hocus pocus to begin with. Yeah. But it does sort of, give you a little bit of outlook as far as when it comes to new housings on the market. The other thing that's interesting, I think, out of this whole thing is looking at the number of single family starts. This is still lower than it's ever been. I mean, we're higher than we've been since 2009, since the bottom of 2009. I think we're around 600, somewhere around there. The low in 09 was right below 400. But prior to this, I mean, we had a steady stream of housing starts above 1,000 to 1,800 at its peak in 2007.
That would be 1.8 million.
Yes.
Not 1,800.
Yes.
The index is 1,800. That's how it looks, yeah. So it's 1.82 million. Wish I could get this chart on the screen. It's on my iPhone on an app I have. But this recovery is dismal. One of the reason why we're kind of focusing on this morning, because this entire week is pretty much about real estate. There's not a lot coming out, and certainly the market's rallying, I guess, on the fact that the Ukraine they're talking about, some sort of ceasefire or something or whatever.
Well, Putin's a nice guy. I mean, he didn't mind that a convoy got blew up. So.
Yeah, and I'm not sure that actually ever happened. Never seen any.
Yeah, who knows?
Yeah,
we didn't see any pictures. That's true. We just saw the white trucks.
Yeah. So anyway, but the point is that the market recovery is what do they got after this? So if they've moved it up. We're up 170 points. So you got to respect what the market's doing. We're at 170, 180 on the S&P now. But the housing, this chart that I have in front of me, I'll have to see if I can get this out somewhere, and I could probably hold my phone up to the camera, but it might be kind of lame. So maybe when
after broadcast we can certainly put it up on the site.
When Mitch is on air, I can actually see the camera on the studio. So maybe I'll attempt it and bring it up. But it's pretty dismal. And what we're talking about here is housing actually an element that's going to drive the economy anymore? And what we're seeing is the economy without housing, which is a 1.5% to 3% GDP. And if you had housing in there, it would probably be 4+. But housing's not in there, and there's a lot of. It's interesting here in the Valley of the Sun. There's a lot of activity with real estate. There seems to be a fair amount of building going on. It's sort of like the airlines, though. When you cut out half of your airplanes, and they look busy, but there's only half of the airplanes working. It's the same thing here. Most of the contractors were decimated during the crisis, so there's not a lot of folks hanging around anymore.
Right.
But other than that, that's it. I think we're looking forward to the housing starts number, which whatever it comes out to. There's another element in this housing starts that's not really talked about. I'm looking at all the way back to 1994. There were 1.09 million units being new starts, and the reality is and if you can go back further, those numbers stay up over 1 million. I think let's see here. Yeah, over 1 million all the way back to 1959, according to this data I have here. And guess what? In 1959, there was about 1/3 less of number of population. It was well under 200 million. So you're looking at relative percentage of starts per population is a joke. And it's really, we're still continuing to look at these really weak numbers overall in the economy. So we'll have to see what happens. That I believe that the rally that we're seeing right now certainly isn't based upon any type of economic expectations. If anything, it goes back to what I was talking about on Friday, where bad news is good news. And they're looking at the weaker numbers are something where the Fed's going to keep their foot on the pedal, but I don't think they're going to do that. I think the Fed wants out of the game they were in and try to recoup and they're basically running a giant Ginnie Mae hedge fund. So they're going to let those pay downs come down and hopefully get the balance sheet to shrink. And there's just so many things out there that's potentially going on yet with the banking system and other elements. So let's move on, I guess, unless you got something, Mitch.
Well, just the other thing I was going to add to it was, when it comes to the housing market, it's not going to drive the economy anymore. A lot of experts have looked at the three main transitionary or the three main factors when it comes to the people that are purchasing homes these days. You have the up and coming generations, the 20 and 30 somethings. These are the millennials, as they're called today. They're graduating college with pretty much mortgage payments already in place, but no house to show for it. So Can they take on another house to begin with? You have the I think they're often referred to as the up and comers. Those are the people that are about my age, or a little bit older, that already have a property. They're looking to upgrade their house to something a little bit bigger.
What age is that?
The 30 to 40-year-olds.
I see. Okay. Well, I'm just curious because maybe some of us can't tell what a 30 to 40-year-old looks like anymore.
Yeah. So, I got that baby face still. So these are the people that already have an existing property. They need to get into a bigger house, or they want to get to a bigger house, but they can't afford it because of the high water marks that are still in place on their mortgages. They're upside down still. Yeah. Then you also have the baby boomers that have these nice homes. They're paid off typically, but now what are they going to do with them? They don't want to sell them at the current prices because of the anchoring that they look back at how much it used to be worth. So where do they go from there?
Yeah. I guess we'll move on to from the millennials issues onto what matters. And but the whole point is this: is let's not expect housing to really be the thing that's going to move this forward here. That's not
Right.
that's not going to be it. So anyway, let's go ahead and start looking at some of these charts and looking at what the markets are doing here. Here we're looking at the S&P cash, and it's up 1664 right now, 1771.70. And if you looked at the numbers that were out on commentary today, you'll see that the R2 on a weekly basis is 178.80. We've already went through R1, which was 1966.30. So 1978.80 is the R2 number. I suspect we're going to keep to moving toward that level. The range that I put out as potential for this run was 1968 to 1973. I discussed this on Friday a little bit. It appears that whenever I mention these numbers, the market goes to these extremes. So we are right there right now. We're pushing. The high has been 71.83. We're a few ticks off of the highs right now. We're seeing not at trend levels on the daily. We did see, Mitch, if you wouldn't mind looking in the background, I know that the daily, I think it was 1-2 daily on the S&P cash had signaled a buy maybe Thursday or so.
All right, I'll pull that up.
Okay, yeah. The point of that is that we have seen short-term momentum switch around a little bit. We've got VPM, the PPM 1 is currently 0.15. We're still negative on PPM 2 and 3. 0.007, which is basically flat, and 0.005. So both of those are flat. We're not really seeing any type of turn to the upside. Typically, and I talked about this rally will represent most likely a right shoulder as long as we don't exceed certain numbers, which would put up, I think the highest number I can see is this somewhere around the 1978.80, that R2 on the weekly. And the range above that, then all of a sudden, if that breaks out, is 1990 to 1999. We'll call it 2000. So that would be a new high in this pattern. What's happening, interesting enough, some of these broad-based indices, although highly weighted with the S&P, what we're talking about here is the top 50 stocks will drive most of this index wherever it wants to go. The other I guess some of the mid caps that are in this indice have improved, but they're not making new highs. There's a lot of stocks that are not making new highs in this pattern, and this is really pretty typical. And when we go through the VPM database here shortly, you'll see some of the rotation. There wasn't a lot going on, but when Mitch is going through that, there's a couple things that I want to talk about and feature today that I think are of interest. But for the most part, what we're seeing here is a retracement rally. It feels really good, and maybe if we've got some cash, we've got a fair amount of cash on the books, maybe it makes you nervous. I wouldn't be. This thing's not really going anywhere. We did see some buying, which we'll talk about here in a little bit.
Yeah, and SPY, we got the brand new buy signal for today on 1.2 daily.
It was for today?
It was for today.
Okay.
We've been long on 1.2 weekly for a little over a month. We got in, actually over 2 months. We got in June of this year.
Right.
And so we're still holding steady at that, but I believe we're still flat since that position came on.
Right. Yeah, I think that's the only thing in the global equity strategies at the moment. So we have a fair amount of cash, and I think one of the things that we start to, and this is going through with having this live show now that we can talk about what's going on in detail. What you're seeing every time the market goes down, it's not a crisis. Everything goes 100% in cash. Sometimes what a bottom looks like is having 80% or 40% in cash, whatever the number is. The market consolidates and then sets up another run. Well, on a longer term basis, we're still expecting some sort of major high here. It's continuing to gyrate just like it has in the past. I probably talked about this maybe 3 weeks ago, is when we were getting close to, when we got to the 1991 level the first time. typically we'll go to, we would have went to 2000 and pulled back, but this time we went to 1991, pulled all the way back to 1905, and now we're back at 1971. So it's pretty typical action around that next number. And we call it, when we're going through the figure, which is the big number, the figure is 1900, 2000, 2100, and etc. There are still some longer term, and we'll go through these in a minute, some longer term objectives that are out there that are still likely to be hit, but the probabilities are down around 40% right now. And my expectation is that we should see a high. And in fact, it was interesting when we go to one of the charts I'll show you in just a minute, the futures, we have a cycle coming in at 9:30 today, so in 15 minutes. We'll see how that plays out, and it should be a high cycle for this particular move. And it's a very short-term cycle, but it's one where we should at least start to see the peak of the day. Looking at the daily chart here, not a lot there except for the moving averages have actually managed to flatten out, and we're seeing the 10-period moving average move up, and it hasn't crossed over to the upside. Oftentimes when it does cross over to the upside, that will signal more of a consolidation and a move back toward the range. I talked about this, I think, on Friday, might have been as far back as last Monday, is that it's very possible that you're going to see a retest of this 1905 level. Typically that would happen, and there's still an expectation for it to go below that. I think the range on the downside that I've talked about, 1885 to 1865, is still out there, even though it wouldn't feel like it. That's 100 points from now. We just rallied about 65 in about, maybe 7 days or so, 7 or 8 days. And if the relief is about the geopolitical risk, and that's what pulled the market down, the question always becomes what got it up in the first place, and it's certainly not the economy, any robust numbers. We're seeing the opposite come out of Europe. We're seeing weakness coming in Europe. We're seeing crazy things going on in China. They're actually, maybe their housing market is starting to fall back a little bit. They saw, I think, the 7th month in a row or something of declining prices or something of that sort. So China's always tough because what's real and what's not real, it depends on what they are telling you, since there's a lot of censorship, and you never know what is it Memorex or is it real. And so what we're seeing here on these indices, we are seeing a nice rally, we have seen a nice recovery, but this thing should begin to stall out here. I would be very surprised if we got over this 1978-80 number, which is R2. If we did, it wouldn't last for long. We'll have to see how the next couple of days play out. Let's go over and take a look at the weekly graph and look at the intermediate. The intermediate, we have been flat on the 10-period moving average, which we are now back above, and we're seeing this at 0.03, which is flat. The ppm 2 and 3 are at 0.22 and 0.24, so at but just slightly below trend levels. So we're seeing this sideways trend continue to play out. So we're going to call the extreme 1905 to the 1991 level, which was the old highs, and we're likely to stay in this 1978 to around I believe the number is going to be 43. The S1 on the weekly this week, or the support one, was 1943.85. So that tells me we're probably in that range for this week. There's not a lot coming out. Market sentiment is going to have to drive it. It takes one little turn, like we saw, what was it, Friday or something, when the market was up pretty much just a little bit below where we are right now, and all of a sudden 20 handles lower, just on one news about the convoy or something going on there in the Ukraine versus Russia. And it's interesting because the all of the sanctions were supposed to be about hurting Russia, and it's hurting Germany, it would appear, more than it is Russia. They're not all that happy about what's going on, and it all has to do with Crimea. Has nothing to do with the Ukraine. Sort of, kind of, but it's more about that all the sanctions were enacted because of the Crimea invasion and annexation that occurred there. So we'll have to see how this plays out. There's certainly any turn of the corner, and I believe this so-called ceasefire in the Gaza is about to complete itself. Yeah. So guess what? That means anything can happen there. So we have a continuation of these out back, I guess, behind the curtain risks that are there, and I guess this is the flow of the markets. It's too easy to get in and out of the markets, unlike it was when I started in this world and in these markets when 40 million shares was a lot of shares. So let's take a look at the final, which there's not a lot changed here, and then we'll go and talk a little bit about the treasuries and a couple other things. But the long-term monthly, we continue to be 136, 147, and 1% ppm 1, 2, and 3. Very robust stages. The 10 period moving average, if I bring that up, is 1883, and this was the target zone for the downside that we should reach. Maybe 1905 was it for now, and we'll see a sideways pattern and keep going. As I've talked about for some time, this market is not at a point where it's going to roll over just yet. It is really at a point where it's hesitating as momentum burns off over the next couple months. If we don't get a lot of upside momentum, even if we did print a new high, that would not mean anything significant. If you recall, I was going to look at my notes, and maybe when Mitch is talking, I'll pull these back up and bring this up in a minute so I don't have to look down at my notes at the moment. But I do recall that there was several reversal patterns that I referenced a couple weeks ago when we had all the sell orders come out. And one of them was in July of 2007. And right after that, sometimes about 6 months later, we actually printed a new high. And one of the commentaries going back, I remember very clearly that the market was being driven by just approximately about 300 stocks across all the indices. So it was a very, very narrow number of stocks that were driving the markets higher. And we're seeing a similar thing here with the VPM database at 42%. There aren't a lot of stocks and a lot of items that are participating from a trend viewpoint. And when that happens, we start to see the markets getting closer and closer as the breadth of the market or the number of stocks that are trending continue to narrow down. And I don't know, Mitch, I'm going to bring you up for a second here, but I don't know that we have any way of looking at just stocks percentage bullish versus mutual funds and all that, but that might be.
Actually, so right now we're long, at least the reports that we put out on a weekly basis, we're long 36% of all the stocks within the database.
Okay.
This last week we had pretty much it was flat for the week, even though we had somewhere around 355 trades for this week. Really, all that took place in the mutual fund and the ETF side of things, and that's what I was going to get into a little bit.
Okay.
So, when you look at it, there was no activity to speak of this week on the stock side.
So, it's 36% though is long.
Correct.
Versus the 42 if you look at the entire database.
Right. Yeah. I mean, pretty much what we're long right now is the mutual funds and the ETFs at this point.
Right. Because a lot of the stocks really have rolled over, and
right.
Many of these stocks aren't rebounding. Many of them are actually continuing to decline, even though the markets, they're on a day like today, they're flat or even lower on a lot of these stocks. They're not screaming back and making new highs. So when you're running an individual stock portfolio, it's a much different picture. And the problem is building expectations around large indices and then doing individual SMA accounts that you're selecting 20 or 30 stocks out of. Trying to compare the two is in any and every window is not going to work very well, especially in a market that is narrowing down like what we're seeing here. So let's talk about treasuries here real quick, and then I'll let Mitch go through the database here. So when we go and look at the treasury market, we're seeing a pretty interesting phenomenon, I think, in that we are seeing a continuation of the rates collapsing. I think that's a good word. Collapsing is a good word for this. Let me get rid of some of this clutter on this chart here. And what we're seeing is rates have been moving down sharply. Couple things, I covered this, but I want to cover it again for those of you who didn't see the show on Friday, is that we're seeing a flow of money to the U.S. for a couple things. So we're seeing a bounce up today. We're all the way up to 2.38%, but the real story is about the Bunds in Germany. They're pushing 1.02 to 1.06%. So you're looking basically 1% on a 10-year German bond, and you have to ask yourself, why would I buy that when I can get a U.S. bond for 2.38? And the answer is, I'm probably going to buy the U.S. bond. If you're up late, depending on where you are, and you turn on CNBC Europe, you'll see. Interesting enough, I think there's smarter people over there. I don't know. At least the market folks that come in are more interesting than the mutual fund salesmen that show up on CNBC here, that are always bullish and always whatever. These guys are pretty objective, but when they're looking at the world, and I lived offshore for just a little bit, for about 6 months many years ago, but it changes your perspective because not everybody thinks like we do. And when you're offshore, you see shifts of funds a little bit different. And when you see what's going on in the thought processes that are going on over there, it's a much different mindset. So they would rather own dollars with their cash, and if they're going to own dollars, why not own treasuries? So you're seeing a lot of flow there. It may not necessarily right now be about flight. It may be flight to quality, but it's not being a fear flight to quality, like a lot of times it's referenced through the geopolitical risk and those type of things that happen. So we'll have to see what will go on as far as this market goes. As you can see on this chart, maybe I can blow it up a little bit, but the downward objectives here are down to 2.27 all the way down to 03 on this thing, 2.1168, so 2.16 on this now. This is on a daily graph, and when we go over to the weekly intermediate, you'll see that the objective on the downside is much further down. It's 211 all the way down to 204. So we're looking at a pretty good move down yet. And it's interesting. And Mitchell, when I bring you up and we go through, one of the things I want to highlight today is looking at the bond space, because there are we still own quite a few bonds, and a lot of,
right.
And there's a reason for that. And the high yield bonds have been exited broadly, and they've come back a bit, but they're still not seeing the type of cash flow that they were seeing before. So there's been a shift in sentiment in the bond market as well. So when we go through the database, we'll cover that. As far as anything else goes, gold's still flat, nothing going on there I think to even highlight. It's pretty boring. And I guess if you're a soybean trader, we could talk about soybeans. There's a monster bear market going on. Corn's half the price it was 2 years ago, and you're pushing right now corn at 361. I remember it was over $8, 800 per, and it just hasn't. I mean, that market is collapsing. So I guess maybe ethanol makes sense at $3.60. I don't know, but anyway, there's shifts going on in other areas as well, and we've talked about the impact as well of crude oil. Maybe that's worth bringing up. I hate that oil index. Let me just see if I can find a good crude here. Here's the actual crude futures here on a weekly basis, and we're looking at $97. I don't have a Brent. I don't know the Brent symbol. I think I can pull it up, but I don't know the symbol. But the key number is going to be $100 below on Brent. That'd put us around 94. There's about a $5 premium. They're 102, 103, I think, right now. So oil is continuing under pressure. So this is what everybody's trying to figure out. what does all this mean? We've got treasuries declining, we've got energy declining. Is that because of a perception of a weaker economies on a world? I think in the bonds, I think there's other flows that you have to look at to determine what's going on there. On crude oil, rumor was that Saudi has opened up the spigots and they're dumping oil on the market. Maybe they need money. I don't know what's going on there, but there does appear to be, even in spite despite any of the I guess actions that are going on in the Middle East with the Hamas and the Gaza, it's not affecting crude oil prices, and everybody's kind of shocked that that is not doing that. So let me bring Mitch up and see if we can get some things going.
Okay.
And let's see here. Sort of interesting, since I lost the shot of just you here. So let me go over to this screen real quick. Not sure what happened there, but I will fix it. So Mitch, why don't you go ahead and talk a little bit? Well,
sure. Well, as I mentioned just a few minutes ago, when you actually look at the database and break it out between stocks and mutual funds and ETFs, really at this point where we're seeing the most exposure really is on the mutual funds as well as the ETF side of things. It's not so much that we're heavily invested in those areas. Where we at again this week, Bob? Was it 42.13?
Something like that, yeah.
Something like that. We'll pull that up in a second, but that's where we're invested right now, and that's really when you break it down between stocks, mutual funds, and ETFs, you'll see that it's the mutual funds and ETFs that are really carrying the weight there. On the actual stock side, as I mentioned, it's only 36% that we're invested of all the domestic stocks that we track. So what we'll do is we'll start by taking a look at the database within 2.0, and bear with me one second while I get logged back in. And then we'll jump over to the research side. So again, I'm going to click on research, go to the all stats page, and you can see already that figure is 42.53% right here. This is the investment exposure across the database. So across all 18,357 securities, we're along 42.53%. This week, when you look at it, this was interesting. When it comes to the net orders, we had still a negative outlook on the 1.2, where we had only 157 entries versus the 225 exits. So it was a little bit more negative. We had more exits than buys. But on the 3.2 side of things, it was the opposite story. We had 538 entries and 115 exits. So it gives you a 4.68 to 1 ratio. So a much more bullish perspective on the weekly 3.2 than on the 1.2 long. And again, when you break that down, we're seeing that across the board on the mutual fund side of things. So if we jump over to the dashboard, take a look at the charts, we could see where these buys or sells are taking place. From this high level view of the sectors, you'll notice that it's almost equal as far as the amount of buys versus sells. Some of the sectors have just a little bit more buys than sells. In the case of energy, we had far more securities that we exited out of as opposed to the buy. But when you look at the entire stock universe, we only had 29 new buys come on this week. So that's 0.49% of all the stocks that we track as far as an actual shift within the database. And you can see here that really it comes down to the broad spectrum of what type of individual group are you exposed to, whether or not you saw that specific buy or sell this week. So it really is a mixed picture when it comes to the actual stock outlook within the database. We're not seeing any sort of clear trends, either positive or negative, when it comes to the investment exposure side of things. On the mutual funds, though, there was a shift this week, and it's funny that there's all these real estate reports coming out this week, because what we also had this week when it comes to the activity on the mutual fund side of things was we had a significant amount of buying take place in the real estate markets. So as we load up the charts here, you can see that we had the typical activity that you would see when it comes to these allocation funds. So these blend of funds that are based upon time horizons. We had some buys across the board on that. But when you scroll down, you see that we had a little bit of activity when it comes to the emerging market space, as well as to the global real estate, which you'll see down here as far as this breakdown. So again, most of the activity that we saw really was in this real estate area, either global real estate or domestic real estate. If you look at the net, when all is said and done, we had 147 new purchases on mutual funds this week. So there was some more buying, and again, that is taking place on the real estate side of things, as opposed to any sort of equity markets when it comes to your typical sectors. On the weekly research, Bob had already mentioned that really gold hasn't done much of anything. I did think it was interesting that this week we did see a sell signal finally on silver. So silver had been viewed a little bit more positively as of late because it's theoretically the more industrial metal, but that has been suffering just as much as gold has as time has gone on. And so we finally did exit out of silver this week. Let me just pull this up here. So there you go. You see we had a slight loss on silver. We took a 5.94% loss on this. So we're taking the capital preservation mode on this. And aside from that, we really didn't see much of activity across the globe when it comes to the single country ETFs. And we're still long that one SPY position for the global equity strategy. And so that is the only position that we own at this time. And then lastly, rounding it out at the globe at a glance, we did see some gains across the board on the single country ETFs that we track. So this did bring some of the European countries up to be flat to positive for the year. So that was at least encouraging to see that we had a little bit of good news when it comes to the fact that some of these countries are starting to show gains for the year again. But still, as you can see off this chart, really a lot of the countries that are going to make the headlines where it really matters, they're still significantly negative for the year. When it comes to either Germany, France, or Russia, there's still double-digit losses on the year across the board. So not a very positive outlook when it comes to the state of the economy overseas. And we keep getting reports from various different countries about the fears of recessions coming on. I believe the last one was Italy that actually confirmed that they are in a recession. They had been positive on the year up until last week. Then they went negative for their domestic market. And we're just seeing that more of weakness emerging out of the headlines for the various economic reports that are coming from really the players that you care about in the European Union. So I think that's probably the biggest news worth keying in on this week when it comes to the dashboard. Is there anything else you wanted to add to that, Bob?
Yeah, I'll just come back on the screen here. I'll try to drive here. What I want to look at, a couple things, probably under the funds here. I wanted to talk about the bonds, as we are seeing rates decline in the treasuries, and the related issues, I guess, continue to be positive there from that standpoint. I'm waiting for this to come up.
It's the first time it's been this slow.
Yeah.
Yeah, we are long 89% of the municipalities at this point. So we still have a pretty solid concentration on the mutual fund side of things.
There it goes. I did a refresh. Let's go and look at some of these alternative funds. Municipal bonds, we are still 84% on muni bonds, still long there. And I just thought it was interesting that when you start to look at how these things are broken down, you're seeing the governments, the intermediate, the multi-sectors, we're still long here, 54% of those. And then when you start to get into, I think here's the high yield, we're talking 6%.
Right.
Just about everything's gone in that area. But there's still a lot of traction. Here's 95% on intermediate term bonds, and governments are 100%. And these are the best of breed funds that we have in there, right?
Correct.
Yeah. So, and is there a list of those?
Yeah, it's down below. So every time you click
so
on it,
if you
it
click on
updates
it,
the
you
list.
can see the list. But I mean,
There you go.
there's not. You have to thumb through it. So
You do have to thumb through it. Yeah, I could look at coming up with some better ways to maybe put this out in Excel format as far as the actual constituents of it, something that doesn't get updated but a couple times a year. But when it comes to actually clicking on the charts, you'll see that the list of companies or stocks will update to reflect whatever it is you clicked on.
And from the looks of things, 268 views on this page. You folks aren't clicking on this enough. I think on our, if we go to the main sector page on the front page, we're looking at a lot more, 9,700 views. So, obviously we're not seeing the traction on some of this stuff that's out there. So you definitely want to take a look at that, because there is a lot of perspective to be had. I think for customer reviews, I know mid-year around this time, a lot of folks are doing reviews right now. So there's a lot of information you can bring up here in talking to clients. And one of the things I think is important to understand, and we're talking about just the levels of cash and how the database at 36% of the stock. So a lot of you that might have individual stock strategies are going to be at least 30 to 40%, in some cases more, as much as 65% in cash. It's probably not going to go any worse than that. Everybody thinks we go to 2008 mode. We don't. We go to maybe 40 to 60% cash is about as far as these strategies normally go. I only saw in all of the years since 1999, since we've had this database visible like this, and whatever number of stocks are in the database, there's only one time that I've seen it go virtually 100% cash, and that was in 2008. Even in 2001 and 2 and early 03, we did not see those kind of numbers. We saw what I'm talking about is maybe 40 to 60% in cash. There's, as somebody said, I don't know who said it, but there's a bull market somewhere all the time. And you can look at some of the top stocks when you go into VPM and look at that, you're going to see a lot of stuff that is still, really rolling forward in a big way. There's still lots of momentum stocks. Not every momentum stock has died. I have a stock Deckard in my portfolio that's done really, really well, and it's just keep buying tennis shoes or whatever it is they make, I guess, and having a good time with that. But bottom line is, you're not going to go probably much more cash. So very possibly the protection that we've already taken is what we see. This uptick in the database is 1 week, but it's very possible that we see a consolidation. And because most of these stocks, we talked about 66% of the stocks are already gone in cash into a neutral mode, into a protect strategy. So you're not going to get a lot more than that. And this is probably what this thing looks like. Maybe it gets a little worse, even if we do see a 10% correction. I don't expect the whole world to fall apart on underlying stocks. We'll see some of these ETFs maybe continue to pull off maybe, but for the most part, we've already went to a lot of cash there too. So if you're going to go to cash, I guess you think about it, you want to buy low, sell high. We sold high. We bought reasonably low back in 2012 when this trend started. And you want to be in cash right now. This is a good place to be in cash. It's funny because people get nervous. The market's at within 1% probably right now of an all-time high, and it's like we got to own more. They're worried that the market might make a new high and they don't own enough. On the individual stocks, like I said, there's not a lot of stuff that's going to drive it. So even if you own something, you probably wouldn't get much on the upside. And other than owning a few stocks that are driving these indices, even those, if you look at them, not every one of those are making new highs as well, but they're recouping, and that's one of the things that we saw happen. Matter of fact, I mentioned it, and I believe in commentary where we were talking about the biotech index. The biotechs were the bad boys of the first quarter.
Right.
That thing is like screaming, and I didn't really look to see how have we done on that sector exposure on that, on healthcare. Can we break that down and see here real quick? Here's biotechnology. We saw some buys. We're still pretty low on this, and see what shows up down below here. Yeah, so you've got how many stocks are in that group? Do you know, Mitch?
I'll be able to tell you in a few minutes.
Okay. But the bottom line is that this has been driving the markets here. One chart I'm going to flash over and get.
There's 168 in that
Okay.
particular group.
I'm going to get Mitch and I both off. I want to show you a chart that I didn't discuss that I have been covering for a while. I've been talking about the EFA versus the S&P. Guess what? New lows on this chart, which is the opposite of what has to happen for a top in the market to see that we're going to unwind. So not only are Europeans buying our treasuries, are also buying our stocks, and that's some of the shift. There's some cash flow, international cash flows going on. It's interesting. If I move this chart over, go to the emerging market chart, you'll see that it's not as it's relatively stronger than the EFA is. And didn't you say, Mitch, when you're going over things, that we did have a
Yeah, we did see some more buying take place on the emerging market side of things.
Right. We didn't buy back EEM, did we, on the daily, did we?
I don't believe so. I'll double check that.
I don't remember seeing an order on that. So, but yeah, so this, I wanted to bring this up because this is key, I believe, to what's going on as far as these charts go. I believe this is still a key for me to see the unwind starting and see the cash flows start to come out of the U.S. and to somewhere else. And these two indices, we've seen the same pattern over and over again. It goes up for a little bit, and then it goes to a new low again. And this goes, when I open this chart all the way up, the chart on the far left at the top here, that's the lows in '09. So this has been going on for the entire rally since '09. And this is 2014. And August, almost, we're working on August being done here. We're, the 18th today or something? So
Yes, sir.
So,
yeah, EEM, we are still long on the weekly model, the
Right.
weekly 1.2. We've been long on it since April, so we're up about 8.5% on it. But when it comes to the actual daily one that's in the Global Equity 4 that we've recommended a lot of people to use, we're still flat on that one. We're still waiting for that next buy signal to come along.
okay. Yeah, so something I talked about, and see what we're doing. We're really not rolling over real quick, but here's that 5-minute graph that I talked about earlier. And these are the cycles that are due to fall in place here. Let me see if I can move this over a bit. Ooh, okay, that was quick. So we just had this cycle come in here just a few minutes ago. We're starting to see, we'll call it a little bit of weakness, but this thing should roll down. This is about a 2-hour cycle. I believe it's 55 bars on this. It's a Fibonacci 55 bar cycle, and this is due to come in a couple hours. So the next cycle should be, it's actually been going from high to high. So whatever we do, we should start to see a rotation from high to high to a high to low, and then if it starts to decline for a little bit, you'll see a low to low cycle pick up. And right now it's been a high to high cycle. You can see over here all the way from the beginning this morning, there was a high cycle, it went down, here was a high to low, and then it's been going high to high for the last three cycles that have been out there. But a couple things I guess I got going on some other stuff. I didn't cover this, and I wanted you to see it. And the result of this has been, here's a cycle that came in on Friday. This is a little longer cycle. This now what's been running is a 34-hour cycle, and this is a 24-hour futures chart. So we're not due for this bottom or this next cycle until sometime late tomorrow or early on Wednesday morning for this thing to hit. I've noticed that these cycles have been expanding a little bit over time, so I just wanted to cover that. So I guess what do we got for our stocks of the day here, Mitch?
Got a couple different ones. First off, I thought it'd be good to talk about Dollar General. Just like we saw with the Pilgrim's Pride, or was it Pilgrim Foods, not Pilgrim's Pride, Pilgrim's Foods, as well as a couple other companies that were in that buyout competition. We're seeing that take place within the dollar stores. So right now, ticker DG, on a 1.2 weekly basis, they just entered today, I believe it was, the bid for Family Dollar. And we are long this stock, been long on it a whopping week. And we're already up 9% on it. So we've already done made a little bit of gains on it just off these headlines.
Did I not get it? Hang on 1 second here. That should be on. Not sure why it's not showing up here at the moment. Okay. And where were we long from?
We got in at 57.94.
So we'll just go over to VPM here, bring it up there. It's DG, right?
Correct.
There we go. That's interesting. We had this one of those crazy where we got a spike and a reversal and then back in again on this thing, and it pretty wild. I wish I could, every time I see a chart like this, that second buy, that anytime you get a trade and we got out and next week or 2 weeks later there's a new buy, man, please do that trade. That is just like the most significant trade you're going to see. And it sounds like, I guess some of you are worried about the $7 ticket, but it's really not the $7 ticket that's the enemy. The fact that you bought in, sold it, and got back in doesn't mean anything other than there's another new trade. But those reversal trades are usually the best trades. We've been trying to find a way to look at those, but 9 times out of 10, these things are screamers when they come back in on the second one. And not all the time, but they are most of the time are really, really good trades. And we used to call them the gotcha trades on the trading floor days. As soon as you sold out, you realized you did the wrong thing and you had to come back in. And those are the hardest trades to make, but they're also the best trades to make. And as one of my old buddies used to say, it's never easy. And if it's an easy trade, it's probably wrong. If it feels good, it's probably wrong. If it feels scary, it's probably the best trade you're going to make for a while. And those are things we've certainly seen over time to look at. So,
what if the price is higher though after you sold it? So like in this case, it was.
Well,
I think we bought in.
That's always mostly the case. Is it's going to be higher because it's a reversal week. He's playing devil's advocate. He's messing with me. So anyway. So, but that is normally what happens. Is it's going to be a higher trade because what happens is the market's declining and then it hits a point, it reverses, and then you come back in. And of course, in this case, we came in, I guess last week, huh?
Yeah, just last week.
Yep. So up 8% already. Let's take a look at, I want to see something. Let's follow this through just a little bit. What was the last? That's interesting. Last loss was 8%. So if you didn't do this trade, you're crying about the 8% you lost instead of about the 8% you've already got back. So you've already got that
right.
trade back in literally a week. So you got to do these trades, and especially if these things are on your screens, you got to do these trades. It's just the way it is. And from looking at just the technicals on here, you're really not seeing anything that's trendy. We've bounced back into this target range here, but for the most part, it'll have to, if it holds here, then we'll start to see the PPM start to kick in. So what else you got?
Well, let's talk about Family Dollar. So that's the company that they're buying, FDO. And in this case, I believe the original buyout was for around $76 before there was a class action lawsuit put in place because they thought that the price was undervalued, and then lo and behold, the new price came out today for the buyout from Dollar General for $79.85. So it's trading right at that higher level at this point.
Got it. Yeah. Yeah, you can see, and we own this thing, and it drifted down. We talked about this just a couple of weeks ago. I remember going, and this is a thing, once again, just talking about trading and buying stocks. Since when do you buy something? It just goes up from the point you buy it. The answer is something like 85% of the time You'll have adverse excursion from wherever you own anything. Doesn't matter if you're flipping coins, VPM, whatever you're deciding to buy this thing for, fundamental analysis. The fact that you're going to buy something at the perfect time is probably not very true. But if you look at many of the trades, and the reason why sometimes we'll buy on these breakouts, and when the trend starts to get in place, the amount of adverse excursion is usually lesser. In this case, we saw the thing decline from around, what is this number here, a high of 70 all the way down to 60, only to be at 80. So that's the type of things that you're going to see when you're seeing these kind of stocks. So this momentum, all of a sudden, we're at 233, 122, and 0.34. Very robust trend levels. And this 10-period moving average on a weekly basis is coming up strongly underneath this thing. So that'll be support probably somewhere around 72, 76. It'll take about a week or two to get up there. The current rate of change right now is, this thing keeps jumping around, Mitch. Are you moving your mouse?
No, I'm not moving my mouse.
Okay. Well, it keeps jumping around every time I try to do something. I'm not sure what's going on there, but it's around about $5.50 per week on the change right now. So that's going to get this market to go up. It's around 69 right now. It'll be 72, and it will jump up. So there'll be really good, solid support underneath this market to support this trend. So next.
All right, next one, and probably the last one due to time. Let's talk about Urban, URBN, Urban Outfitters. They're going to announce earnings after close today.
Okay.
And we've been in long this stock only about a week or two.
Right.
I got in on the 4th at 35.64.
Yeah, and so this trend, same kind of deal. The short-term trend 0.48, which is the PPM1, and 0.04 and 0.24, both negative numbers. So there's still some underlying downward pressure on this thing, but the fact that we're trading back above all these three averages now is pretty positive from the standpoint of the trend turning. So positive momentum doesn't have to be on all three levels for VPM to go in. It's going to look at these patterns and attempt to find patterns that are going to appreciate. So you'll see those type of trades. There was one back over here that looked similar, where the market, we'd been in and out, then we were out a little while. Looks like about 6-8 weeks. We came back in, and there was a decent trade there. So this is, I guess, back to school trade, huh?
I guess. I mean, it's part of that same retail market, which has been struggling a little bit. Urban Outfitters, I know it's appeared on a number of screens, I think value screens for some time. It's had a tough go of it, just trying to make a name for themselves after those initial gains that they had back in 03, 05.
Right. Yeah, and it is a constant dynamic shift going on. So go back. Let's take a look at the last couple minutes here, and we'll look at the very short term. You can see this is the live futures, a 1 minute graph looking at this. This is starting to see, it's trying to roll over here. How far it can get, we're 4 or 5 ticks off the highs right now. When we look at the cycle that I talked about a little while ago, if I can get to the right trade here we go. You can see since this cycle came in, we're starting to see these 5 minute graphs start to trade off. So about 2 hours from now, we should see a bottom. They're going to attempt another run to the upside at that point. So there looks like we're going to try to keep this thing positive into the close, that final couple hours that we'll be looking at there. And then from that standpoint, then we're probably going to maintain a pretty good upward market today. And we could close well over this. The extreme for the day was 1969.45. So close over that. A couple things are happening. Is expanding the range. The 3-day range is 14.59. So it's up from the 10 level that it was on Thursday and Friday. So we're definitely seeing expansion of volatility. And as I discussed in the commentary, I expect to see volatility stay reasonably high and probably move back to around 20 over the next several days. So it looks like our time is out, and we'll be signing off. We'll see you on Friday, and that will be probably summarizing what we possibly are seeing right now is the high of the week, or close to it. We could see one more day. So anyway, folks, have a great day. Mitch and I are signing out here, and we'll talk to you on Friday. Thanks again for coming.